Awesome. So today we've got an interview with a very special guest, Simon Pullman. Hi, Simon. How are you?
Hi Mark, I'm good, thank you.
Good, good. Simon's got a very unique story, and I really wanted to document this. I'm big into trying to sort of delve into people's processes and how they sort of achieved trading success. And you've got a very unique story, and I'd love to hear sort of the beginnings of it, how you came to trading, and also how quickly things started to work in your favour, which is really interesting.
Yeah, I was an independent financial advisor. I've been a trader now for 11 years, independent trader for 11 years, but before that I was an independent financial advisor, and I was giving advice, specialised in giving advice to medical doctors. They generally had a fair bit of disposable income and often had some savings, so I was giving a lot of investment advice. And it was all going very well, I was doing okay, but it started to get very tricky to actually provide the sort of returns that I hoped to give my clients. Fixed interest, commercial property, stocks and shares, and obviously deposits in the bank, and that weren't really providing the sort of returns that I wanted to give my clients and they wanted to have themselves.
Yeah.
Also, they weren't giving me the returns either. You know, I had a little bit of money, not very much at the time, but I had a little bit of money. And I wanted to try and make that to work for me a little bit harder. So I started looking at other ways of making money. Didn't really come across anything too interesting to me until I was talking to a guy at work he was dabbling around doing some option trading in his spare time and some spread betting. I didn't really know what spread betting was, but when he told me about it, he seemed to be making a little bit of money at it. And I thought, this sounds good, because all the other option classes that I mentioned there before, stocks and shares, commercial property and the like, had to go up in value for a client to get a return. If they went down in value, they're going to lose money, simple as that. With spread betting or CFD trading or whatever, this type of Forex trading that we're talking about, you can actually make money when the markets go down or up, as long as you pick the right direction.
Yeah.
That was like a revelation to me. I thought, this is fantastic. How do I get going? Let me at it. I wanted to get my teeth into it straight away, and so I started looking at it and doing a little bit of research, but there's not as much out there on the internet as there is now, and I was not overly brilliant at deciphering it. Oh, there's my front door. That's typical.
That's okay, mate.
Just bear with me.
Do you want to get a... Yeah, no problem, mate.
You couldn't believe it, could you? That's typical. But a life of working at home.
Exactly.
Yeah. So where was I? I was looking into doing the spread betting or trading, and not really getting anywhere. I love the idea of it, but I was making all the mistakes that most people do at the start. And although it seemed easy, I couldn't seem to get the direction very well, and I just kept on. I was demo trading for a start, and losing a bit of money with that. Started to make a little bit of money, so I opened a live account and really struggled. Went nowhere for about a year, I would think. Probably 9 months. I loved the idea. I thought, yeah, I'm going to master this, but I was really, really struggling with it.
So do you had any? Can I just ask you? Did you buy in any education, or were you just buying books, reading, like sort of self-taught?
It's self-taught really, just seeing what was available on the internet, and then actually experiencing it live, just
Right.
trying to trade, trying to see what happens, and as I was going nowhere really.
Nowhere. So what's that So let's explore that transition. So had you tried the simulator demo type trading in a professional manner, or were you kind of a little bit up and down with it, and then you went live, or did you make that transition as professionally as you could? Do you think?
I transitioned to live trading as soon as I could, because even though I wasn't making money on the demo account, I thought that you never really find out until you're dealing with your own money. I was making trades on the demo account that I thought I probably wouldn't have made if I was actually trading my own real money. And so I put very, very small amounts in, just obviously very small accounts with the micro lot sizes, but it was still money. It was still money that if it was £10 that I lost, it was still £10 I could have had.
Yeah.
And so emotionally, that's very, very different to trading demo accounts.
Yeah.
And
So can I just ask as well? So if you were sort of to give some advice to a new trader, would that be it? Would it be, yes, go live, but go live in a really, really small amount?
absolutely, absolutely, because I think I had emotions at that time when I went live with my own money. The emotions I had there were probably stronger than I have now when I'm dealing with multi-lot trades.
Yeah.
Yeah, huge amount of money difference, but
Yeah.
the micro lot one was actually affecting me more because I was so new to this, and losing, as I say, £5, £2. It seemed like, oh no, I could have had a pint with that or whatever it was. It
Now you're talking.
yeah, so it was great education because it meant a lot, and I wanted to make it work.
Would you mind talking, because it's a really interesting thing you've mentioned that. Would you mind talking about what were these emotions and when were you having them, and how did you actually transition to be able to, as you say now, be a multi-lot trader and not really care about it anymore? By contrast, maybe
Yes,
not
yeah,
entirely.
I still care, but it's not quite. It's not
Yeah,
really
yeah. Sorry.
ups and downs.
Yeah.
Yeah, the emotions, I suppose, were. I was a very big screen watcher. I was too much of a screen watcher. I was just watching it all the time, and every time I have probably the classic green for an up bar and red for a down. And when you see a nice green bar coming on, you think, oh great, it's going my direction. Isn't that great if I'm trading long? And then the red one comes, and the emotions are so negative. It's the same as probably everybody's been through. Any beginning trader will go through.
Yeah.
And it was because I was looking at it too much, looking at the screen far too much, and I was up and down like a yo-yo. I was almost a gibbering wreck at the end of the day. It was just too much for me, and it's only very small amounts of money, but it was still really important to me. And so to get past that was just take a step back from it. And if I was reasonably confident that I'd made the right trade call, then I would step away from the screen and go and do something else for a little while and just come back and have a look at it. And in that period of time, it might have had, if it was half an hour or so, you've got 6 5-minute candles that have been going up and down, up and down, up and down, which my emotions would have been up and down with those. But because I've been away from it for half an hour and come back, then I was only affected by that one emotion when I came back to it.
Right. And so over time, strangely, that allowed you to develop the skill sets to lessen the emotions, or are you still doing that today?
Yeah, no, I can watch the screen all day now and have very, very little difference in sort of heart rate or feelings now because I've done it for so long. But it took a long time to get there. The way that I did it, I think the way that helped me was I found a strategy which I like the look of. I did a lot of research. I was a big researcher. Did a lot of back testing of data and just seeing what would work and what doesn't and what worked over a period of time. And the more research I did, the more confident I was in the strategy moving forward. So I could be less emotional about it because I'd seen all this happen in the past.
Yeah.
Even though I hadn't traded it, it was how it had actually been fallen out of the past. It's how it had actually happened in the past.
Yeah, so that's really interesting because I think one of the biggest problems that traders face is the old system hopping issue.
Oh,
and I think a lot, and I think a lot of it comes from what you've just said, that because they've first of all, they've probably got no framework to take risks safely anyway.
Yeah.
But beyond that, it's not having the trust in the strategy, is it? And if you've got no data, if you've got no back testing,
absolutely,
then it's very difficult to take that leap of faith when you're in your first drawdown, isn't it?
It's huge, yeah. And I was actually just interested you say it because I was doing some testing on a new indicator, I suppose you call it, a trend indicator that I've seen and reasonably like the look of. I just thought I'll have a look at it and just test it to see if it could add any value to me. I do this periodically just to see if there's anything out there that could help me because occasionally there are things. And I just did a test. It was on a daily time frame on this indicator, and it was over a 5-year period. So it's a good old test. 31 trades were taken, it's got them written down here, and at the end of it, 2,761 pips were generated from just purely taking it when the indicator said to go into it. Nothing else, no support resistance levels, nothing Fibonacci or anything, just purely when the indicator said to go in. So you could probably fine-tune that to make it a lot better. But he still made 2,761 pips on one instrument, which was US dollar Japanese yen. That sounds okay. I mean, it's not a huge amount of return, obviously, but it is something, and so maybe it's got value. But when I checked down, 31 trades, 16 of those were losers, and only 15 winners. And there was a period of almost a year where we didn't have a single winning trade.
Right.
Now that's a profitable system, just on that one bit of backtesting I've done, but who's going to stay in that system if you're going to lose every trade for a year?
Yeah. So that's interesting. So it's not, so the back testing doesn't also just provide you with the confidence to go forward. It actually uncovers some truths about the strategy which might not fit your personality. We hear that a lot, right?
Very good.
It's going to gel with you, etc.
Spot on, Mark. Yeah, absolutely. If you can put yourself in that position where you've got a year of losing trade, I know it's only one instrument, US dollar Japanese yen, and maybe other ones would have been making money in this time to counterbalance those. But let's say they weren't, and you're losing for that period of time, then that's going to be a real test of your emotions, and I'd be stretched on that to keep going. But because I've seen it before now on this, if I did take this forward into something I do in the future, then I know that can happen, and so not to panic when it does, because
That's so good. That's unbelievable information. Brilliant. You've got the trust in
it. That's key. That's why I do loads and loads of manual back testing. Loads of it. And then if I'm really convinced about a strategy, and in the past I've had a lot of the strategies that I've manually tested turned into robots, effectively, algorithms, had them built by companies to just to build them, so then I can just set them onto a good tick data platform that can test the strategy then over a huge period of time in all different scenarios. It can't test slippage, but it can do everything else, and so it can give you a really good idea whether that is going to be a great strategy going forward.
Yeah, that's fascinating. So I was just about to ask you, so that's a really interesting thing you just said then. So you start off back testing it, you do that manually. Have you so hang on, I'll get back to that. So you do that manually, and then once you think you've got yourself a winner, you then get that turned into an algo for a bigger test on a bigger data set, so that you're ultimately confident.
Correct. If it's possible to do it, because not always, not every strategy is possible to turn into an algorithm, and you can get these produced relatively cheaply. $200 or $300 often can turn your strategy into an algorithm, and then you can test it.
That's fascinating. So do you have a process then for this? Is super fascinating, and the reason why is because everybody is like a headless chicken in the beginning, and they don't really know what direction to go into. Yeah, but what you've done is you've gone down that route to define a process, to find the winners and the things that won't work, and it's systematic. That's super interesting. So the ones where you kind of you put them in the paddling pool, if you like, where you're doing it manually, is that just through that process what you mentioned earlier, just keeping one eye out on the industry and just seeing if there's anything, as you said, would add value, and then you pop that into that process?
Absolutely. I mean, everybody that looks on the internet will better see that there's loads and loads of information out there, and loads of strategies that people are supposedly saying that this is a guaranteed winner for you. Now, I might try those, and I would have done in the past, just have a look at them to see if they did stack up on a bit of back testing, and maybe then tweak them to change to sort of make them more profitable. But most of them were found out to be not particularly great over a good period of time, or not good enough to take any further forward. But some are, and the ones that were, then I would then expand upon. And I didn't invent anything. I just purely tweaked what was around and made things better for my own state of mind and my own trading technique, really. And then if I could turn it into an algorithm, then great, because the ones that once you've got the algorithm with the back testing, you can then obviously still forward test with it. So you can set it up on a demo account, make sure it works properly, and see how it's generated in real term with the slippage and everything that's involved. And then if it works well, you can actually put that onto a live account, and then it takes your emotions pretty much out of it because it's making all the decisions for you, so you don't have to worry too much about it.
That's brilliant. Wow. So when you're putting the new ideas into that process, do you have one eye on not only new things but things that actually you've gravitated towards and been successful with previously? Are you looking to stay in a certain niche within trading?
Yeah, I'm pretty open to any idea, and I have traded lots of different methods over the years, and most of them have been profitable. Some more than others, but I've tended to combine, I think, ideas quite a lot to make sure that I'm still within my comfort zone a little bit. So I know what is likely to work, and I don't like to get too far away from that. But I'll certainly be open to anything that happens. One particular one that was quite a revelation to me in the early days was a mean reversion strategy that I pretty much came up with that. I did see something on the internet about it, but I actually did pretty much, I suppose, invent it, or invent the rules for entering the trade, certainly. And that was massive to me. When a currency pair is overextended in one direction or another, the likelihood is it's going to have a retracement at some time. And that retracement, if you get it extended out to a good level, then that retracement is probably going to be fairly big. And I was just literally trading those retracements, which made a massive difference to my profit line, because that was I was trading the euro pound, and I had a year where I didn't have a losing trade on that euro pound because it just wasn't going to get too far away from its mean level. It just went, when it got itself overextended, it came back.
So one of the sort of more frightening aspects of that type of strategy that people will sometimes be frightened of is at what point will it turn? Yeah. And did you use any? Was it candlestick patterns? Was it pivot points? Was it Bollinger Bands? What was it that actually made you confident that this was where the turn?
It was a mixture. It was a mixture of them. I use envelopes quite a lot. They're quite useful. Mixture with Bollinger Bands. Candlestick patterns are very useful. I mean, I used to use them a lot. I don't use them quite as much now as I used to do. But candle can tell you an awful lot what happens. But there again, that's only a snapshot what happens in that particular period. On another time frame, it won't look quite as rosy as that. But they are useful. I started to use Heiken-Ashi. I don't know if you've ever used it yourself, Mark, but the candlesticks which smooth things out a little bit more, and they can give you often a good trigger to enter into a trade. But the real mixture on this mean reversion one, it was a real mixture of technical indicators. But the key one was, has it reversed at a previous support and resistance point or a Fibonacci level? So that was manual. That was never ever, that you couldn't possibly ever have that done into an algorithm. It had to be, I've got those all marked on my charts, and if it was actually turned at that point, I thought it's very likely that it is going to go down now, or go up, whichever way you trade.
Yeah, you brought up my issue with creating algorithms with the trading I do. It's just there's every sort of element of it is different, which is just it's impossible to try and quantify. That's interesting for people.
So now the algorithm trading that I do is probably 20% of what I actually achieve profit wise. Nearly all the profits are generated by the manual trading. It's nice to have.
Oh wow, that's interesting. Oh wow, that's interesting. Is that by design, or is it just how it's kind of happening?
I think it's both really, because I don't want to trust too much money into something that I don't have full control of. So I was happy to take the levels of trades that I was taking with the algorithms, but if there is something that happens outside of my control, it can easily have a massive impact on your profit line. You know, a trade could take a big hit on your bottom line. You know, it can go the wrong way very quickly. Whereas manually, if I'm trading it and looking at it, I tend to be paying more attention to those trades, so that's not likely to happen, and more attention to the economic news that's coming along. And whereas the algorithm are just trading in the background with a relatively small amount of money and just ticking over and making a steady sort of return, and I'm more comfortable with that.
Right. That's interesting. Yeah, I sometimes use the analogy when someone has some very definite problems with trying to deal with a trade and they ask me, should I close the screen down? My advice was always no, because although it does work, right, but I used to always think it was papering over the cracks for the moment you're in front of your screen, a news event occurs and you're not prepared to deal with it because you've not fixed those issues, and that's when you're gonna get into trouble. But ironically, you did that to get you going, and then now you can handle it, and you prefer to be in front of it, so that doesn't happen.
Absolutely, yes. Yeah, and I was always looking for something else. I never really wanted to rely on one strategy anyway. It was always looking for 2 or 3 that I could use to trade and that complemented each other, that didn't get in the way of each other, and that's how I've continued.
That's fascinating. And just going back to the mean reversion idea, Simon, when you were talking about a level of support and resistance where price had turned previously, was there any sort of definition on whether or not that particular turn had to be like a really vicious pivot and it made a brand new high or low from? Was there any sort of characteristics of those particular levels that you focused on more than, say, something that was not so bad?
I think on the charts I'm pretty clear at which levels I feel are very strong point levels, basically, you know, that could cause an impact, because there may be ones that have the price has reversed off several times over quite a long period of time. You know, you're looking back on a chart, and this level has been a key level for a long time. And if there is also some complements with a Fibonacci level as well that would go as well as previous support and resistance, then if you've got, the more bits you've got there, the better. You know, that's a stronger level as far as I'm concerned. And then if you get the right price action at that time, because price action is what it's all about. Price can just blow straight through those levels, and you know, they don't respect them. You know, they don't know they're there. Yeah, price doesn't know it's there. But if it does respect it and actually does make the right sort of price action at that point, then I'm happy to jump in that trade, because it's a very high probability trade then, particularly if you're very overextended on the price.
Right, that's interesting. So are you prepared to go in just on a couple of candlestick entries, or do you want like a retracement or something?
I've got quite quickly.
Solid?
Yeah, as soon as I see if it's overextended long, as soon as I start seeing some bearish price action, I'm in it. Yeah, probably on a 15-minute charts. So a couple of 15-minute candles that are looking good to me, then that's respected, and I'm in it. And it got fairly tight.
So I must have.
Well, so it's
right. Okay. I was going to ask you about that, actually. So I've probably added a trade or two to that strategy then, have I? So when it breaks the level, there's the stop on, and then it goes back. You can now add that to your arsenal.
Exactly that, and that has started to happen more and more, which is, you know, why it's very interesting to come on board with you and actually see what you were doing, because I've noticed that those levels were not being respected as sharply as they used to be. And this is probably in the last 18 months I've seen this more than any other time before. They are being hunted out. Those low, you know, the stops are being hunted, and then now if it's coming down, then you're really certain of it. You know, this is coming onto what you do obviously so well.
Wow, that's very interesting. You made that observation. Fascinating. So in terms of stops then, Simon, what's your average stop, sort of risk percentage per trade?
I've got 3 strategies I run, of which 2 of them I have just disaster stops in there. So which are probably minimum of 200 pips away, maximum of 500 pips away from the price. So a huge distance away, and they're never going to get hit, as far as I'm concerned, unless a disaster does happen. You know, something crazy like, you know, the Swiss, you know, franc, you know, unpinning itself to the euro, and then you have a massive sort of move. But that's happened so rarely that it's almost shouldn't be counted. It's only in there just to stop my account being wiped out.
And don't trade the Swiss.
There's that. Okay, now the damage has been done. It's the other one you need to worry about, I think. But the other one, the mean reversion one, then I can have fairly tight stops of around about 40 pips, 30 pips, 40 pips, and usually that covers it off, because if the price goes back up to that level and goes through it, then the chances are it's invalidated my trade, and there's no point staying in it. You're going to get hit for more if you just move your stops further wider out.
Yeah. And do you feel any pain now that when you take a stop? Do you have any?
Yeah, I do, but it's nothing like it used to be, and it's only very, very minor. It's just but in a way, saying that, it's almost, if I'm in a losing trade and it's getting near to the stop, I almost feel better when it's taken out. That sounds a bit strange, but when it's taken out, that trade's gone. That's history. It's just one of the statistics that's gone down. That's a losing trade. That's fine. My average would be probably 80%, 81%. I think it is a successful trade. So that's one of the 19%. The other 81. I'm likely to get a few now winners. It's going to be good now. So, and it clears.
Super impressive. Super impressive. So that's interesting that you still feel it, because I mentioned this to the guys in my coaching, that it's like, unless you're a kind of psychopath, which obviously there are people out there functioning as psychopaths, and they're probably traders who maybe never feel these things once they've sort of understood the game and now the numbers work. But it's probably not a place where you get to where it's a utopian version of emotion. Would you agree with that? It's just the volumes turned down so much in contrast that you can totally handle it, rationalizing it in that data and in your previous trading, your experience, and all of those things.
Absolutely, it's part of trading. You have to accept you're going to lose some trades. It's not always easy just to brush them off completely, but as you say, the volumes turn down so low that it barely registers really in the longer scheme of things. So.
Wow. So in terms of these levels, and in terms of you're having such an impressive win percentage, in terms of how long you've been doing this, so how long have you been profitable now?
After that, when I went full time after the first year of 9 months wasn't profitable. Then the last 3 months of that year I was, and I went full time, and I've been profitable ever since then, which is 10 and a half, nearly 11 years.
That's fantastic. So, are you trading higher time frames, or are you trading high time frame levels, and then you're going down to see a bit more detail to enter? What's the time frames you
the main? I trade three strategies. The main one I do use, and the biggest one, is I look for a trend on the daily. The daily time frame is key to me, and if the daily is pretty clear which way it's trending, then I can look to get entries in that direction on a lower time frame.
So do you use anything to confirm that? Is it a 200 moving average or something, or is it just the structure?
Yeah, I look for. I don't use 200 moving average, although a lot of people do, and so I think it's got a lot of validity. But I don't actually use that. I tend to use. I've got a custom-built indicator that just helps me look at several different areas and just gives me a little spot on the screen that tells me that it's likely to be, the trend is likely to be up at this time. But I don't take any notice of that unless the turning point of that swing high or low is supported by structure, which is obviously support and resistance, previous support and resistance, and or Fibonacci levels, or both. And if it is, I've got a confluence of all those three, then the likelihood is that trend is going to be sustained for a period of time. And then I can look to get in on, I tend to look also, I like to see the 1 hour going in the same sort of direction, and then I look to get in on a 15-minute sharp time frame.
Right, so you actually like using the flow of all those different time frames in conjunction with each other, because sometimes they can be off, can't they? And that's confusing.
Oh yeah, you can get the 4 hour going in opposite direction completely to the to the daily. And until it comes into line, then, you know, you're going to take a bit of a guess, really, about which way it's going to go. But there are lots of different ways of assessing which way the trend is going. My way isn't, you know, maybe the best out there, but it works for me. And as long as I'm convinced that swing low or swing high is in place, and we've got a nice daily trend that's going to be going for the foreseeable future, then I'm happy to take a trade in that direction. As long as, you know, but I'm looking for a trigger, an entry on a 15-minute chart.
Okay. So are you able to find a level every day, or how often regular would you say that strategy?
I trade 20 pairs with that strategy, and also occasionally an indice with that. But so normally I've got a trade open or 2 or 3 every day, but I'm not. I don't always open a trade every day.
Actively,
yeah, it would be maybe once every 3 days, maybe, that I'll be actually taking a trade. But I've often had 10 trades open running at the same time, which, you know, use up a bit of margin, but that's okay. You know, it's sort of manageable. Yeah.
Okay. So would you say that's the key then to your high win percentage? Because I know that I've been teaching for years now, and no one's ever come up to me and said, Mark, nice to meet you, can you teach me how to trade weekly time frames? Right? It's like everybody's gravitated. Yeah, it's like play the shiny lights, and everyone gravitates to those lower compressions. But as you go through that experience, then you realise that well, you tell me, what advice would you give someone? Would you say try and make that work, or would you say come out the compressions?
I think looking at the higher time frames is absolutely key. Whether you trade on the higher time frames is irrelevant, really, but you need to know what they're doing, because otherwise you're fighting the trend, and that's hard to do. You can make it work, but it's much harder. Why make it harder for yourself? I don't. You know, I just go with the trend, and really, you know, I can get caught out occasionally, but very rarely. So it's, you know, I think you look at the higher time frames. If you know what they're doing, then you can drill it down to the lower ones and look for your entries. Get a good entry at that on a retracement somewhere that gives you a good chance to come in. You get the right price action on a 15-minute or even 5-minute chart, whatever it is, and then you could enter, and away you go. But what's helped me is, and this is not the best advice for newbie traders, is taking the stops very wide, because I'm confident that what I'm doing is going to go in my direction. It's just, so I don't need to worry about stock being taken out, or, you know, being a big reversal in the wrong direction and hitting me hard with a, you know, big drawdown. I do get drawdowns, but I'm still confident that the direction's right, so it will come back into line, and that then makes it much easier, much more relaxing to trade, rather than worrying about a stock that's a bit too close being hit.
And just to clarify for people who are new, you're not just taking a big stop with huge risk attached to that, are you? You're adjusting.
I mean, I'm lucky enough now to have made a fair bit of money doing this, and so I've got quite sizable accounts, which allow me then to just take the 1% trade risk on each trade, 1.5. I tend to go to 1.5 normally on each trade. So even if my disaster stock gets hit, I'm losing a very, very small percentage of my account. So it is a fairly big account, so I'm still trading multiple lots with that.
Yeah. And I think that's key to point out, though, because a lot of people, especially new, the balk at the idea of having a big stop. And you and I, you know, we tend to trade with big stops. It doesn't necessarily mean every day I'm trading with a big stop. You know, sometimes it's 100, sometimes it's 2, sometimes it's 40. But it's position size and setup dictated, rather than some crazy amount of stop that I can't possibly handle.
Absolutely, and I don't think you should have set stops as well. If you're trading different instruments, then you've got, let's compare pound New Zealand compared to Euro Swiss. You know, I mean, the daily range on those is enormous. You're probably 10 times on pound New Zealand compared to the Euro Swiss. So you're not going to have the same stock for those, otherwise it's crazy, you know.
So that's really interesting. So what you're basically saying is not all stops are created equally, certainly not in terms of the currency pair or whatever you're trading. And so how do you go about what tool, if any, do you use to understand that volatility difference?
Yeah, there are lots of tools again just to show you but the average true range will give you a good idea about what the volume on a daily basis has been traded by that currency pair. Which gives you an idea about how much it can obviously move in a couple of days if things go against you or for you. So you can set your stops and your take profits accordingly on that basis. And
so do you do like a multiple of ATR, and what period do you
not really.
tend to?
I tend to have a reasonable idea about where you can see by the size of the candlesticks really what the average the daily range is roughly going to be, and I will then take that away far enough away, the stop far enough away from that to be comfortable with it, and then look for some structure in the charts to hide that stop behind.
Right. Do you do any analysis on any previous pullbacks in recent history and understand what the ATR of those were, just to give you any additional confirmation?
Not extensively, no. I am aware of them,
right.
Particularly if it's recent times, because history does repeat itself quite surprisingly on Forex. I'm sure you've seen it. It's
there's some symmetry in that.
Yeah, what happens when this happens? It often happens again, and so it is worth doing that. But I don't take it back too far. If I'm going back 2 or 3 years, then I'm not really interested too much, because the world is a different place now. The banks trade different to what they used to do there, and the major institutions trade differently now. There's still a lot of similarities, but it is still different to what it was 3 years ago. I think it's harder now than it was 3 years ago.
Yeah.
I'm glad I'm not starting now.
Oh, don't do that. Everyone will be crying.
It's still manageable, but it was a lot easier. I think the process that I went through was we didn't have people like you, for instance, or other people that help you see through stuff that took me forever to learn. Really, I would probably never have come across something that you talk about, or never understood it like you do, because you specialise in that area. Other people specialise in other ones, and I can pick their brains on that, and I can understand what goes on with that. So I learn by those. If you're left up to your own devices, which I was at the start, it was hard. But luckily, the markets were a little bit easier to predict, and so it was a shorter period of time for me to get going than it would be now if I didn't have the help of other people.
And so do you because there's a lot of hate out there on the internet with people who are educating in some form. But you see it differently. I'm sure there's some people are due that hate, I guess, but also there's people out there who can bring.
Yeah, there are more fake gurus in every walk of life, I think, than true ones. But you can normally tell when somebody does know what they're doing. That sounds a little bit smug to think that I can do that. I can't always do it.
No, but you're a professional. You have the right to say that.
Some people quite clearly are just big salespeople that haven't really come up with anything new, any new ideas, and just follow me and away we go. And I don't know. I mean, but there are lots of people out there that are very talented, very good, and they like to give back. It's a lonely place, trading, to sit there, and sometimes it's nice this is quite nice today, just to talk about
I've absolutely loved talking to you.
Sometimes you think, well, I do that, but you don't think why you do it too much, because it becomes so, you get so insular with it and just in your own world. But there are people out there that definitely can add value, and I advise people definitely to look at them, but take everything you see and read with a pinch of salt and test it yourself as much as possible. And you can nearly always do that. You can look for things. What you teach, you can go back and see the structure of the markets and what happened, and does this happen like Mark suggested it would do? Yes, it did. No, it didn't. It won't do every time, but you think, oh yes, on average, it actually does. You know, it actually does more times than not. Maybe he knows what he's talking about. Maybe I'll stick around a bit longer and listen to him. You know,
Yeah, good. Fascinating. So the other thing as well, I'm quite. The reason why I'm doing these started to do these interviews is I don't know whether you saw an interview I did with Dr. Anders Ericsson.
yes, I did. Yes, it's on your site, isn't it?
Yeah,
Yes.
I did saw that, and yeah, it was a bit of a disaster. It was actually a brilliant interview as far as I just loved the process of speaking to him, but the blooming recording screwed up at the end, unfortunately. So
I've not seen it all. I've seen probably about 15 minutes of it. But yes.
Right, yeah, about 40 minutes in, it goes all a bit wrong. But what I'm fascinated in is like what you're saying there. Trading's a lonely game, and you kind of just you're in that rhythm now. But you have so much value to deliver to someone who's on the other end of this conversation, who is starting out or who is in the process and struggling. Like what you know is valuable, and if we can try and get deep into those processes and then just give that back, you know, I just think it would be a wonderful thing to do. So.
It's interesting you should say that, because I've got a friend was out to dinner with them about a couple of years ago, and they both of them have got very, very good jobs, but very well paid, very comfortable life, children support and everything. And the lady that she said to me, "Can you teach me to do what you do?" She was a bit disillusioned in her job at the time. And said, "Can you teach me to do what you do?" Right. And she perceived the lifestyle that we had, it was better than theirs, whether it is or not, it doesn't matter. But and she thought she wanted to have a bit of a taste of that. And I said, "Yeah, I probably could teach you how to do it, but it doesn't guarantee that you'd be profitable." And that's because it's how you handle. I have some losing trades. It's how you handle those losing trades. And if you get 2 or 3 of those in a row and you're losing all that money, you've never been used to doing that. You know, you've only ever had money coming into your bank account from working. If you've actually see it going out, as well as your bills and everything else, but actually your account balance going down, how do you handle that? And, whether she could do it or not, she might be able to do it. But it was just the drink talking probably at the time that it was...
the time the barbecue
was on. Was greener somewhere else. I thought, I could teach you everything that I know. I could teach you over a period of time, but then could you actually make money doing it? Possibly, but possibly not as well, which is amazing, isn't it? Really.
Yeah, fascinating. But I think in there somewhere I'm heading to. I want to go towards that. Like I want to find out if we can make it possible for anyone to plug into it, you know, because on the face of it, as you say, it's like, can you handle that emotions? But I think the answer somewhere lies within, do you have a framework for risk? If you do, that back testing is a big thing. I maybe don't talk about that as much as I should, and then just put them in an environment that's safe, and that's the key. The problem is the broker gets them. And the damage is instant. It's too quick, and if we could just, I don't know, like get in front of those people just for 5 minutes and somehow deflect them away from it being a bad thing, because it gets such bad press, but it's one of the most wonderful businesses in the world.
Yeah, I mean, I was excited when I first got into it. I'm excited now about it. I'm still excited every single day. I come down and I love coming to work. You know, so I'm at home, but I'm in my office here at home. But I just love coming to work.
And I've noticed the bottles of red wine.
Oh yeah. Not quite as full as it was before. Yeah.
I wonder why. Brilliant. Well, I've only got a couple more questions if you don't mind. I just wanted to, just because it's a big thing people struggle with. Do you have a set plan for exiting your positions, or do you manage those? Just talk to me a bit about that.
When I first set the trade up, then there is a plan to exit where I want to exit, and that's based on support levels and Fibonacci levels and risk to reward. I'm happy with, but.
What are you not happy with from a risk reward standpoint, and what?
I'm still happy at sort of taking some trades that are 1-to-1. Now I won't go less than that, but I will do a one-to-one risk reward, because although I've got a disaster stop out at maybe 500 pips, let's say, sometimes I know where I'm going to exit that trade, and it might be at 100 pip level, let's say. So I'm looking then for at least 100 pips in the positive direction for me. But mostly I'm looking for a multiple. So mostly I'm looking for at least 2, occasionally 3 to 1 on the trade, and sometimes more than that. I mean, if I'm going into a daily time frame and I've got in on it quite early, then I will be looking for a very, very big move with a smallish stop in place. Oh, not in place, but in my mind, that would probably 5, 6, 7 times risk to reward.
And do you mess with the? So, is there a point that you go to break even, or is there a point that you don't? Or you don't do that, or is there a point where you start to trail it? What's sort of your idea?
I'm not a big fan of trading stocks, I must admit. I can understand why people do,
Yeah.
and it's the fear of losing, what you've got in there already. But I'm not a fan of it. Another professional trader that I converse with regularly. He's a massive one. He tries convincing me to trail my stops. But when I tested it over the, I did do it for a period of time, like everybody does for a while to try things. When I did test it, I wasn't as profitable doing that. And I got irritated as well, because that stop gets taken out because everything reverses at some time. It has to go and get more buying or selling orders. And then it takes off again in your direction. You think, well, what did I do that for? I'm just losing money. That seems crazy. Just let it do its thing. It's never going to go in a straight line. Just let it retrace, let it come back, and then occasionally I will add. Occasionally, if I see a really good point to reverse to, then I might put a little bit extra into it as well, into the trade, and because I want to just press the winners effectively that I have. But that doesn't happen normally, but I do sometimes.
So you said so much in that. So you mentioned that sometimes you're going for a set R, but that sometimes changes. So is that price action dictated? What is it? Is it like a news event comes out and it's positive for your trade?
Fundamentally, and if there's a big news event around that, then I might, this week I've just taken a trade off now this weekend because I didn't want to expose to was a Swiss franc one that was with the referendums this weekend. So I just wanted to take that away. It's not reached my profit target yet, but it's still in healthy profit. I'll take it off, and then I'll come back to it and maybe put the trade back on again next week, because that is, something that's out of my control. That can completely scupper my trade. It was a perfectly good reason why I got into it, but something else outside of my control has actually stopped it going to where I wanted to go to, or potentially.
Massively interesting what you just said there, because I talk about this where it's if you get involved in that trade, there are some moments in which it's a logical decision to do so. It's not based on emotions, it's based on pure logic. The referendum's happening in the said country, I'm in the currency, I'm not at my target yet, but I am in money. That is a smart, logical decision. You're not doing that out of anything other than logic. It's when it becomes that it's like the tail's wagging the dog. That's where the problem lies, where you are emotional and you're making these decisions.
Yeah,
there's a difference.
Yeah, definitely. If it's based on sound reasoning, which hopefully this is, then I think that there's nothing wrong with closing your position down early. You can always go back in. You might well regret it, coming out, because it could easily go in your favour. But half the time it is and half the time it isn't. I'm not interested in coin flip things. I want something in my favour. I want an edge on the market, and that doesn't give me the edge. That's just purely that's a coin toss, whether it's going to go in my way or not. So what's the point in being in a trade if you're just going to be doing that?
Yes, that's interesting as well. Well, we're getting into some wonderful
weekends as well. Sorry, weekends are also times that I occasionally shut a trade down, just purely because there could be a big thing happen on the weekend, and you get this big gap in the market that goes against you. And occasionally I will shut trades down on a Friday. I normally let them go, but if it does look particularly, the world looks a bit volatile, or if we've got the North Koreans shooting missiles again and that, then it's just a little bit scary at times. If I'm involved in a currency pair or an indice that could be affected by this, then I might close a trade early.
Right. So again, wonderful insight. So essentially, being high time frame traders, going for multiples of R when we've got larger stop losses, which obviously will follow. We're going for hundreds of pips in profit. As that type of trader, you've got to go through weekend and risk events that could occur over those weekends. But at the same time, so we're okay doing that, but at the same time, there are moments that seem pretty predictable. If like in the week up to the weekend, North Korea are firing missiles, there's a good possibility something might happen over the weekend, and you just don't want to be involved in that because you're.
And if nothing does happen, what have you lost? You've lost the spread basically on your trade. You just go in again and enter your trade again. You bank that profit, you enter a trade again. What have you lost? Virtually nothing. So, and it's a much safer way of trading, without question.
Trading. The other thing I was going to say as well is, when you get into a profit target and a risk event occurs that's net positive for the trade, is that another reason that you would stick with a trade beyond your set?
Yes, I think so. Yeah, I think. If price action and if everything's going in my favour still, and all the things that I look at suggest that the price will go further than expected, then I'm happy enough to stay in that trade longer. But it rarely happens, because what I do tend to do is to on a daily time. Although I'm looking for the daily trend, I'm actually getting in on a 15-minute time frame. So my entry will be on a 15-minute. I'm looking to exit that trade normally on a 1 hour time frame. So when the 1 hour looks like it's going to turn, I will exit that trade at that time. If it hasn't hit my stop take profit by this time, but the 1 hour looks like it's going to turn back and retrace for a period of time, I will exit that trade and let the retracement happen, then get in again at a better price and take chunks out of that daily time frame trend, if that makes sense.
Great insight. Yeah. So you won't. So where I'm a sadist and I'll hold through those.
More active.
You're actually coming out of them.
So you can actually get more.
Right, okay.
It can work against it because you think it's going to make a retracement and then it just bombs off in the direction again. So you're out the trade and think, oh, no, I've missed it. But I quite like getting in on that hourly time frame. Getting out on the hourly time frame, because it allows me then to do it in chunks. And very often I'll get more out of a run than the actual pips from top to bottom of that run. I'll get more out of it by doing it this way.
Okay, great insight. So the obvious question is, when that price retraces, do you place your stop in the original position, or do you
stop wouldn't have been moved? It would still be a long way away. I mean, I might bring it down a fraction, but it will still be a disaster stop in place with a mental stop that's there that I'm thinking if price comes back to this level, then it's effectively invalidated the trade, and I will look to exit unless there's a good reason not to do. But you can often get a thing that people with tight stops, and I used to do this with fairly tight stops. You only have to have a temporary economic news event that comes out. Obviously non-farm payroll is a big one that happens, but it nearly always is temporary. It's not. It doesn't follow through for days afterwards, and that. It's normally on the day you get a spike. It spikes down, then it goes a little bit in that direction, but then after a day or so, it's all settled back into what it was before. But if you've got your stop somewhere in there at 50 pips or something, your chances are you're going to get taken out. And there's no way I want to be out of a trade through something just a temporary little bit of noise in the market. It's I like to stay in it, and so then the stop is a long way away, and I'll just have a mental stop to get out of it.
Right, and are you just using the same logic? You're looking to pull back into structure
exactly
again to go back in.
So as soon as I see it turning at a point which is previous support and resistance, then I will be looking to get in again on that trade. As long as nothing's invalidated and still the daily trend is still down, let's say for instance, I'll be looking for a pullback up north. As soon as it hits some support and resistance and then shows me a little bit of bearish price action, I'll be back in again.
Wonderful insights. Thank you very much. I guess I've only got one last thing to ask you, and that is, you've been thank you very much. Very generous with the information as well. Yeah, it's been absolutely fascinating. So What advice would you give the newbie or the struggling trader? Is there anything that you wish someone had told you?
Yeah, the big one is jumping from system to system, as far as I'm concerned. Try and do as much research as you can on one system that looks like it's got merit. If that system has when you're doing the back testing of it, if that's got give you a real edge in the market historically, obviously there's no guarantee it continues in the future, but the chances are it will do because markets haven't changed that much. If you've done enough back testing and manual back testing of that, and you're confident that that should be profitable in the future, then stick with it. You'd have two of these, I think, two different ones that complement each other, that don't get in the way of each other, that is. So you have a longer time frame strategy and a shorter one. And if you can run both of those, then emotionally, if one's not doing so well, the other one might be doing quite well, and so you don't get too up and down with the emotions. But I think if you can just stay with one or two systems that have proven themselves in the past to be successful, then you will make money at this. If you are dedicated, if you handle your risk to reward, and you follow through your entries correctly, you don't just get some bad price action and come out of the trade quickly or whatever, just stick to the rules, you will have an edge in the market and you'll end up winning. I used to be very big on sport, and I used to play quite high level table tennis, and it was in the days when table tennis used to be up to 21, it's up to 11 now, but up to 21, if I beat somebody 21-10 in a game of table tennis, then I've hammered them. I've beaten them really easily. In trading, if you've got 21 winners out of 31, so you've lost 10 and won 21, then you've won. As long as your risk reward's good, you are going to make quite significant money on that.
Yeah.
But in those 10 points that the opposition win, or the 10 losing trades that you have, there probably would be a time where they might have a run of 3, 4, 5 losing trades, or they win 5 points against me, and suddenly it's how you handle that emotion to deal with it. There's nothing wrong with your your methods and that. It's just sticking to them, and it will come right. And my algorithms that I've in the background prove that. They have times when they have drawdowns for a month or two, and then bang, they're back into normal action, and it works, and just ticks over at a reasonable level. So I think just sticking with one or two methods. If it's proved to be successful when you back tested it, then that would be my one key bit of advice to new traders, I'm sure.
Advice. And just finally, I'm cheating. I'm asking another question. It's kind of just a comment on what you said about when you're in a trade and it's coming against you. Don't choke off its potential. Just accept that as just a normal and necessary part of
absolutely. It has to do that. The market has to do that. It's not possible to just keep on going in one direction. They need to have people that are selling or buying to be able to do the opposite, and so they have to come back to be able to get some new orders. So the price has to move. It's natural, and you should welcome it almost. I get a little bit stressed when I see the price going in one direction too far, because I know it's going to happen. I'm almost wanting it to happen. I'm wanting the retrace to happen, so it's out of the way and done with. Yeah.
Done with. But I always think of it as always one scary moment just after I enter. Always plan for one scary pullback. Brilliant. Brilliant. Simon, it has been an absolute pleasure. Thank you so much for your time. The information is gold. Study this, go over this, watch this as many times as you can, because what Simon's just shared there is invaluable.
Thanks, Mark. Appreciate it.
Simon, thank you very much.
Good luck, everybody. Bye-bye.